Well, let's put it this way. I don't think they'll increase rates. They'll hold it here. And in June or so, I think they'll go and move lower again on the rates. In other words, they'll cut rates, and they're not out of bullets. They can also, like in Europe, introduce negative interest rates, which Miss Yellen in 2009 suggested already then. If it were possible, I would introduce negative interest rates. And I think that is still a possibility. Now, the interesting aspect about this policy is the following. You have European bonds, say German bonds, yielding less than zero. You have Japanese government bond, 10 years, yielding less than zero. And 10 years US Treasury notes are yielding close to 2% at the moment. The yields have gone up a little bit, so 1.98%. With this huge yield difference, the dollar should be much stronger. So my view is, if they cut rates in the US, if they go to negative interest rates in the US, the dollar will tumble. You said you would put dollars under your mattress. I tell you, I wouldn't trust the US dollar in the long run. I think the dollar in the long run will be a weak currency.
Really?
Yes.
I want to bring Sri in. Sri, did you hear that? We have it on record, on tape. Doctor says the negative rate scenario in the U.S. is still not, we can't push it away yet.
Yeah, I've got some sympathy with that view, and I think the dollar bills, the structural dollar bills, have been put out to pasture largely. But I wanted to talk to Mark, and love to see Mark, about the China experience in all of this, because the property market, once again on the mainland in Tier 1, is happily blowing bubbles once again. And this causes some very real unintended consequences, doesn't it? We have not seen, in my opinion at least, a fully fledged repricing, clear out, or a blowout, call it what you want, of the bad debt in China. That is necessary. And in your opinion, Mark, is a nasty credit event round the corner in China that's going to make Lehman look like a birthday present?
Well, this is a very good question, and you ask 50 different economists and you get 50 different answers. My sense is that, yes, we have a colossal credit bubble in China, and this credit bubble has to be deflated. But you have to understand one point. A lot of the credit growth in China was admittedly misallocated. But equally, a lot of it was used for infrastructure and for capital spending. And that will ensure future economic growth. In the Western world, the credit bubble is in many cases actually much larger, but the money was not used for future productive investments that will generate the cash flow, but is actually used as transfer payments from essentially taxpayers A to taxpayer B. And that is essentially, in the long run, negative for economic growth.